Now, in order for this strategy to work, we need three components. We need uninterrupted compounding interest on our money. That's the most important. We also need loans at a lower rate. That's also important. And then we need optional loan payments. We don't want to be making a loan payment while we're in retirement. We're not going to try to take out a home equity line of credit to retire on and then have to make a loan payment on that in retirement. Of course not. We need optional loan payments because we're going to live on loans in retirement at a lower interest rate, and we're going to allow this uninterrupted compounding to do its magic, right? So how do we accomplish this? Are the banks ever going to offer you a loan at a lower interest rate than what they'll give you on a savings account? Of course not. The banks are the ones making money doing what I'm trying to teach you how to do. The banks understand what we call positive arbitrage or positive gains or a positive or leverage, whatever you want to call it. The banks are giving you a loan at 5 or 6% or 7 or 8% and giving you less than 1% on your savings. That's obviously not going to work. How about taking out a 401k loan? Does your employer hand you a check when you take out a 401k loan so that all of your money can keep growing for retirement? Of course not. They are simply giving you early access to your money without a penalty. That's all a 401k loan is. And of course you have to pay it back. So there's no optional loan payments. How about margin loans? Now we're getting there. We're getting closer. Remember the wealthy? Remember Elon Musk? Remember Jeff Bezos? They could allow their stocks to grow the rest of their lives, and they could take out what we call margin loans. A little risky because if you don't have as much money as they do, first of all, they're only going to let you borrow up to about half. And if the stock market crashes, they're going to make you sell your stocks to pay off the loan. A little more risky, but it could work. And the other problem is hard to live on in retirement because they're going to make you make a loan payment on those margin loans. So it could work for part of the strategy, but not all of it. How about real estate? Could your house appreciate at 6%? And could you get a mortgage? Harder and harder these days, but could we get a mortgage at some point in time in our lives at 5%? Yes, we could. Okay, so that could work. Have you ever met a mortgage company that will give you a home equity line of credit or a second mortgage or a first mortgage without making you make a loan payment? Unfortunately not, right? The banks tend to want these loan payments. How about a reverse mortgage though? Believe it or not, a reverse mortgage could work. We could borrow money from the bank using our house as collateral. We could have all that money to live on in retirement without making any loan payments. Now, again, I could spend a whole nother training talking about that. I'm not going to go into that in this particular training because some of you are a lot younger and this is not going to apply to you. This is only going to apply to those who are older, but it is an option for those of you who are older. How about whole life? Whole life is going to allow you to grow your money uninterrupted, and they do allow you to borrow money without a loan payment. That's interesting. But your average return on a whole life policy is going to be in that 4 to 5% range. This is in that fixed category. The growth on this is fixed. It's in that fixed to 4 to 5% range. And the loans are just like a bank. Okay, whole life companies work like a bank. They're going to try to charge you 6 to 8% on your loans. So your money is going to grow like this. Your loans are going to grow like this. It's not going to work. Even though they give you an optional loan payment, you're going to need to make a loan payment or this whole thing is going to go south in a hurry. So it has an interesting feature, but not quite what we're looking for. How about the new kid on the block, the Indexed Universal Life Insurance? This is using that index growth that we keep talking about, where your money is actually growing like this, okay? You're guaranteed to never lose. You can still get the upsides. That's going to give you that 6 to 8% average return. And if you choose the right company, you can get a fixed percent loan at 5%. Right now, with interest rates high, you could take out a loan, give it to somebody in a hard money loan at 10% and make money on the loans. Yeah, even with high interest rates, you're guaranteed to be able to borrow the money at 5. I teach people how to use this to pay for college because you could borrow the money to pay for college and have all of your money keep compounding interest. And yes, we still get the optional loan payment. There's only one problem, and that is the high fees of the life insurance. That's why everyone says, don't ever use life insurance as an investment. It's too expensive. I know this because that's how I was taught. I was taught when I started in the financial industry to tell everyone, never use life insurance as an investment because it's way too expensive. Okay? Now, here's the secret. High fees equals high commissions. Low fees equals low commissions. There is a way to keep the fees low. In fact, this is what the wealthy do. This is how the billionaires, the banks, and the large corporations use these index universal life insurance differently. Here's an example of bankdirector.com. You can go to the website and they'll teach you how banks use life insurance. It's different than traditional life insurance contracts, okay? High cash value. That's like having an insurance company savings account. This is not term insurance. This is like having an insurance company savings account. High cash value, low insurance. That's the key. The cost is low compared to other insurance products. The problem is that insurance agents get paid a commission on the insurance. That's why nobody does this. But the banks, the large corporations, and the billionaires are doing it because the fees are low. Even Tony Robbins talks about it in his book on Money Master the Game. He went out and interviewed like 50 of the smartest people when it comes to money. And in chapter 5, he actually talks about the secrets of the ultra wealthy that you can use too. And they like it because of the tax advantages. It's a legal way to invest all without paying taxes on the gains. Pretty cool, isn't it? They call this a rich person's Roth IRA, but it's not even the billionaires that are using it the most. It's the banks and the large corporations. In fact, clear back in 2014, Wells Fargo had $18 billion in what they call their tier 1 capital in life insurance, cash value. Have you ever wondered where the banks are investing their money? Yes, they are using some of these strategies because of the tax benefits. You can borrow against them. They have all sorts of benefits. They're guaranteed to never lose, the whole 9 yards, okay? So the big secret is low insurance, high cash value. The insurance savings account. That is the key. Let's take a look in more detail.